People always assume my best stories are about the big winners, Coke, Apple, Geico. But the most expensive lessons I've ever learned were not the winners. They were the mistakes. And if we really do walk into a nasty period in 2026, those mistakes are going to matter a lot more for you than my home runs. Let me tell you something. You don't go broke from the crash you saw coming. You go broke from the behavior you repeat because you never admit to yourself, I was wrong. So today I want to talk to you as if we were sitting in Omaha, just two friends at the kitchen table. No fancy charts, no predictions with 3 decimal points. Just one old man who has seen more booms and busts than he can count, walking you through his biggest investment mistakes and how you can avoid making them right before a possible 2026 storm. Setting the stakes. My friend, I've seen this movie before. People feel uneasy. They hear about recession, election, war, debt, and crash. They scroll all day. They sleep very little. They do very stupid things with their money. And here's the funny part. The danger is not only what is happening in the world. The danger is what's happening in their heads. The most important asset you have is not your brokerage account. It is your temperament. Your ability to stay calm when the world tries very hard to make you crazy. If you and I manage your behavior, you can get through a crash, a panic, even a so-called 2026 crisis, and still come out ahead. If you don't manage your behavior, it doesn't matter how smart you are. You'll blow yourself up. Now, you might say, but Warren, you're the Oracle of Omaha. Surely you don't make big mistakes. Well, let me correct you right there. I've made some spectacular ones, and they are very useful for you because they show you what not to do when emotions run high. Why talk about mistakes before a crash? You understand, I don't know if 2026 will bring a crash, a soft landing, or something in between. Anyone who tells you the exact month or day is either fooling you or fooling themselves. But I do know this. At some point, you will see something that feels like a crash. It might be in 2026 or 2028 or the year after you retire. The date doesn't matter. Your reaction does. Most people prepare for crashes by chasing predictions and new trading tricks. That's like preparing for a tornado by buying a nicer weather app instead of fixing the roof. Wrong problem. We are going to fix the roof. We're going to talk about the behavior that ruins people and the rules that save me. Because, believe me, I have paid tuition to the University of Stupidity many times. I just made sure to learn the lesson and not repeat the course. A few of my real mistakes. Let me give you a taste of what I mean, and later we'll dig deeper. One of my biggest early mistakes was buying bad businesses because they were cheap. They had low stock prices. They looked like bargains. In my 20s and 30s, I thought I was very clever finding these. I bought a company called Berkshire Hathaway because it was cheap. Not because it was wonderful. Not because I loved the business, but because I felt annoyed with the managers and wanted to teach them a lesson. That decision cost us tens of billions of dollars in opportunity over time. I turned a cheap textile mill into my holding company, but if I had simply invested in great businesses instead, our numbers would look much better today. Let that sink in. My ego and my obsession with cheap over wonderful cost more than almost any crash ever did. Another painful category of mistake, buying into things I did not fully understand just because they were popular or growing fast. Whenever I broke my own rule, I eventually got reminded why the rule existed. A circle of competence, for me, is simply this: things I truly understand well enough to judge their future. Not things my cousin says are great. Not things that are trending on the internet. Things I could explain to a 12-year-old without bluffing. When I drift outside that circle, it's like I'm flying a plane in fog with no instruments. It may seem okay for a while, but when the weather turns bad, I find out very quickly that I'm in trouble. And then there's the big emotional mistake I've made and watched others make, underestimating how fast fear spreads and how contagious institutional failure can be. I saw it with long-term capital in the 90 seconds. I saw it in 2008. I've seen it again with certain banks and with crypto platforms in recent years. You get smart people, big names, huge buildings, and underneath, very fragile structures, little stress, a little loss of confidence, and the whole thing starts to wobble. That's why, before any potential 2026 crisis, I want you to understand the difference between normal market volatility and real structural risk. They are not the same thing. Volatility just means prices bounce around. They go up, they go down, they make you uncomfortable. That's normal. That's the price of admission for good long-term returns. Structural risk is when the system itself is shaky. Too much debt, too much leverage, bad incentives, no margin of safety. Leverage, by the way, is simply using borrowed money to invest. It feels wonderful on the way up. It is deadly on the way down. Now, why does this matter to you and not just to Wall Street? You might say, Warren, I'm just buying index funds in my retirement account. Why should I care about your old mistakes or some fancy institution blowing up? Because every crash, every panic, every failure of a big institution eventually ends up on the doorstep of the everyday investor. It shows up as prices falling so fast you can't think, headlines screaming that everything is broken, your friends selling in a rush, your own brain telling you, get out now, you can always get back in later. When the music speeds up, most people start dancing faster. They don't step away from the edge. They move closer. And I don't want that for you. I want you to be the calm person in the room. The one who says, I've seen this movie before. I know the rules. I know what not to do. So here is how we're going to use our time together. First, I'll be very honest about my own biggest mistakes. Not in the textbook way, but in the kitchen table way. What I was thinking, how I was wrong, what it cost. Second, we'll look at how seemingly solid institutions can fail and how that trouble leaks into your life even if you never set foot on Wall Street. Third, I'll walk you through how past crashes really felt in real time. Not with the clean benefit of hindsight, but the way they felt when everybody was scared. Fourth, we'll break down the step-by-step mechanics of a crisis, what actually happens when the music stops. Finally, and most importantly, we'll talk about rules. Simple, practical rules you can use to protect yourself, keep your head, and maybe even benefit when others panic. You won't leave with a prediction from me. You'll leave with a plan. Now, let me give you the emotional frame for all of this. Let me say this plainly. You do not need to be the smartest person in the market to do well. You do need to avoid being the most emotional. You can get rich slowly by being consistently reasonable. You can get poor very quickly by being occasionally crazy. My biggest mistakes were not made because I suddenly became stupid. They happened when I let pride interfere with the facts, when I chased cheap over good, when I wandered outside my circle of competence, when I underestimated how fragile some structures really were. If you can spot those same patterns in yourself, you're already ahead of most investors. Before a storm, pilots go through a checklist. They don't just look at the clouds, they check the plane. In the same way, I want you to check your financial plan before any 2026 storm shows up so that you are not flying on luck, rumors, or hope. You know, if you only listen to the headlines today, you'd think the whole world is either about to explode or about to make you rich overnight. But what's really going on underneath all that noise is a lot less dramatic and a lot more dangerous because it quietly shapes how you think and how you behave. So let me give you a diagnosis of what's really going on. Right now, most people are not investing. They're reacting. They open an app, they see a green number or a red number, and their mood and sometimes their entire strategy changes in 5 seconds. You understand that's not investing. That's mood management. The financial world has turned into a 24-hour casino lobby. Prices everywhere, opinions everywhere, very little signal, a lot of adrenaline. So before you and I talk about any possible 2026 crash, we have to be honest about the water you're swimming in. We live in a time when attention, is more valuable than oil. Every platform, every commentator, every so-called expert is competing for those few seconds of your focus. And fear is the strongest magnet they know. That means the loudest voices are usually the most extreme. Everything is going to zero. Everything is going to the moon. There isn't much money in saying things will probably be okay if you behave sensibly for 20 years. Yet that boring line has been right far more often than the exciting ones in my lifetime. Now, I'm not going to give you a wall of statistics, but let me paint the broad picture for you. Over the last decade, interest rates were close to zero for a long time. That is not normal. When money is nearly free, people start doing things they would never do if money had a real cost. Companies borrow heavily to buy back stock. Governments run bigger deficits. Speculative ventures get funded because, well, why not? Investors stretch for yield, which just means they take more risk to get a slightly higher return. When that period ends, when rates go back up and money costs something again, the whole system has to readjust. Some projects that look smart at 0% look downright crazy at 5%. Some debts that were easy to roll over suddenly feel very heavy. That adjustment is what you're living through right now. At the same time, asset prices have been pushed up for years. Stocks, real estate, private companies. People start assuming that up is the natural direction of things. Combine expensive assets with higher borrowing costs, and you get a simple truth. The margin of safety is thinner. Margin of safety simply means room for error. If a business is priced for perfection, any disappointment hurts. If a household is stretched with debt, any job loss hurts. If a government is running large deficits, any shock hurts. That, in my view, is the diagnosis. Less room for error almost everywhere. But the numbers are only half the story. The emotional climate matters just as much. A lot of newer investors came in after 2020. They saw big gains, free trading apps, and social media stories of overnight success. Losing felt like something that happened to other people. Then they got their first taste of a real drawdown. Suddenly, some of the same people who laughed at boomer advice started saying, "This game is rigged," or "I'll never touch stocks again." That is how cycles work. First, there's too much optimism. Then there's too much pessimism. Very little time is spent in the middle, where reason lives. If you're not careful, your brain will get pulled to those extremes with everyone else. Up and euphoric, down and despairing. And every time it swings, Wall Street makes a little money off your emotions. Now let's talk about what the big players are actually doing, because whether you like it or not, what they do affects the game you're in. Large institutions, pension funds, big asset managers, and insurance companies are not sitting around watching YouTube to decide what to buy. They're looking at liabilities, cash flows, regulations, and risk models. Many of them are quietly doing something that I'd call sensible, reducing the bets that only work in perfect conditions and increasing the positions that can survive a range of outcomes. They may hold more short-term government bonds. They may lean toward companies with real earnings and strong balance sheets instead of pure story stocks. They may increase cash, not because they love cash, but because they love flexibility. You're not going to see that on a billboard. Nobody runs an ad saying, "We chose to be a little more boring this year." But that silent shift tells you something important. The people responsible for other people's retirement money are not assuming the next few years will be easy. You feel all of this indirectly. You feel it when your mortgage or rent goes up faster than your wages, when your credit card rate jumps, when your company freezes hiring, when your stock portfolio stops making you feel like a genius and starts making you feel like a fool. You may not read the Fed minutes or analyze sovereign debt, but you live inside the consequences of those decisions. And when enough people feel squeezed at the same time, households, companies, governments, and behavior change. People spend less. Businesses delay investment. Politicians argue louder. Markets get choppier. That's what macro risk looks like from your kitchen table. Not a chart, a subtle tightening in daily life. So what are the two real forces you're up against? First, A financial system that's been stretched by years of easy money and high prices, now facing a world where money isn't so easy and prices may not always go up. Second, a human system, you, your friends, the crowd, that is more wired, more reactive, and more easily panicked than ever before. The combination is tricky. Fragile structures plus fragile emotions. If 2026 brings a rough patch, it will not be because someone on TV said a scary word. It will be because these underlying tensions built over years finally show up all at once. But remember, tension is not destiny. It's just potential energy. What turns it into disaster or opportunity is behavior, your behavior. And that's where you still have an edge. You, as an individual investor, have an advantage. Most institutions never will. You don't have to report to a board every quarter. You don't have to justify every move to nervous clients. You don't have to trade every day. Your edge is the ability to think in decades while everyone else thinks in days. If you use that edge, whatever label history puts on 2026 will be a bump for you, not a burial. To use it, you have to see the world clearly. Yes, there is more debt. Yes, many assets are not cheap. Yes, the headlines will try to make you crazy. And yes, capitalism has survived far worse than this. Both things can be true at the same time. The short term can be scary, and the long term can still be rewarding. That's the frame I want you to carry as we move through the rest of the script together. In real time, my mood was not opportunistic. It was deeply unsettling. I genuinely wondered at several points whether the market itself was broken and whether recovery would ever come. Over time, I watched the businesses that created real value endure, while a lot of speculative behavior simply faded away. The 2008 financial crisis carried an even heavier emotional weight for me. The charts now compress it into a steep drop followed by a recovery, but living through it felt like watching the ground give way beneath my feet. I saw well-known institutions fail, I watched emergency government programs appear overnight, and I listened to serious people openly question whether the system would survive. My own fear, and the fear I saw in others, went beyond portfolio values to the safety of deposits and the basic financial plumbing. When people, including me, start worrying about whether their money will be accessible, behavior shifts very fast. I watched solid businesses see their share prices collapse simply because investors needed liquidity. Selling became indiscriminate. At that time, I did not know whether the policy responses would work or when the damage would stop. The investors who kept buying, or at least held their positions, were rewarded in the years that followed. It did not feel rational or comfortable at that moment. It felt lonely. Across all the major crashes I've lived through, I've noticed the same emotional patterns. Confusion is always there, with people operating on fragments of information and unverified stories. Then comes isolation for those of us trying to stay calm while the crowd swings between euphoria and panic. Regret often steps in and pushes people, and sometimes me too, toward impulsive decisions to undo what we think were mistakes. I've watched the narratives flip violently every time. Before a crash, the story insists that prices will rise indefinitely. During the crash, the story flips to this will never come back. In my experience, reality usually sits somewhere in the unexciting middle, but holding that middle view is very hard when the pressure's on. All of this history matters to me because I know future downturns will not announce themselves in a neat package. If a major decline arrives, it will not feel labeled or orderly while I'm living through it. It will feel uncertain, emotionally overwhelming, and socially contagious. Even I will find myself questioning plans and judgment at exactly the worst possible moments. Understanding that feeling in advance has given me an advantage. My life has taught me that every crisis felt terminal to someone who lived through it, yet life and commerce continued. Businesses kept operating, people kept working, and economies adjusted. The investors who paired sound reasoning with emotional discipline made it through intact, and many did far better than they expected. The benefit you have with me talking to you now is that you can use my perspective without paying full tuition yourself. You can borrow the emotional lessons I learned from past crashes and use them as preparation instead of trauma. In the next section of our conversation, I'm going to break down how I've seen crises unfold step by step, from the first subtle warnings to the point where exhaustion replaces panic, so you can recognize each phase while it is happening. When a crash or crisis hits, it does not arrive with a helpful label explaining what stage you are in or how calm you should be. In my experience, it usually begins with something that appears small, manageable, and even boring. Those early signals almost never feel dramatic or urgent to me. That's exactly why they're easy for everyone, including me, to dismiss. The crises I've watched almost always start with a shift in conditions that most people assume is temporary. Interest rates may begin rising after a long stretch of easy money. A once popular sector, whether it was technology, housing, or crypto, starts to struggle. Sometimes a few highly leveraged players blow up in some corner of the market that hardly anyone was watching. In that early phase, I hear a lot of soothing language. Commentators talk about volatility, consolidation, or healthy corrections. The prevailing attitude is, we've seen this before. Buying the dip will work again. And for a while, that belief often is rewarded, which reinforces the illusion that nothing important has changed. That early period worries me because it teaches the wrong lesson. People start to believe they're immune to lasting losses. Every pullback is treated as temporary, and every red day feels like a guaranteed opportunity. Confidence grows just as the underlying conditions quietly deteriorate. Under the surface, I often notice credit conditions tightening. Lenders get a little more cautious with us, ask for better collateral, and take longer to approve loans. Terms become less generous. Nothing feels dramatic yet, but I can tell the era of effortless money is fading. Businesses that depended on cheap debt start to feel the strain. Refinancing gets more expensive, and projects that made perfect sense when borrowing costs were near zero no longer look nearly as attractive. The headlines during this stage are mixed and often contradictory in my view. Some sound upbeat, others are gloomy, and there's no clear narrative yet. Most investors I talk to are still in denial at this point. They assume the old playbook still applies and that the system will just snap back to what they remember. Meanwhile, the institutions I pay attention to are quietly reassessing risk behind the scenes. The public conversation almost always lags behind what the professionals are already doing. Sooner or later, a clear trouble spot shows up. I've seen it be subprime mortgages, a cluster of regional banks, or some highly speculative asset class. Commentators admit there's a problem, but quickly reassure everyone that it's small and contained. That word shows up again and again because it settles nerves. Sometimes these issues really are isolated, but in a fragile system, I've watched supposedly contained problems spread more than once. At this stage, the average investor starts seeing bigger losses but still thinks they're temporary. The real work is happening at the institutional level, where firms I know are asking who holds the risky assets and how that exposure might ripple outward. Then comes the phase that few people outside the industry ever see clearly: funding stress. I've watched institutions that look solvent on paper suddenly struggle to get the short-term financing they rely on. Banks hesitate to lend to each other, money markets pull back, and lines of credit get reduced or canceled. Liquidity, not profitability, becomes the urgent concern. When funding tightens, I've seen institutions forced to raise cash quickly. They sell whatever can be turned into cash right away. That usually means liquid holdings like strong stocks, index positions, and high-quality bonds. Assets are sold not because they're bad, but because they're easy to sell. That's why I've watched strong companies see their share prices fall sharply during crises. From the outside, it looks irrational and chaotic, like everything is going down at once and nothing makes sense. In reality, a lot of that selling is driven by necessity rather than careful judgment. If the pressure keeps building, I know what comes next. Confidence breaks. Headlines get alarming and urgent, focusing on failing institutions and emergency measures. Markets may halt trading. Governments rush out interventions. The tone shifts from concern to outright fear. Public commentary polarizes quickly. I hear some people declare the end of the system, while others insist that this is the bottom. Both sides are guessing. For most investors, their time horizon collapses from decades to days. People who told me they were long-term suddenly can't stand another week of losses. Selling becomes an emotional reflex instead of a strategic choice. Trading volumes surge, volatility spikes, and rumors travel faster than facts. The survival instinct overwhelms rational analysis. Sooner or later, authorities intervene more aggressively. I've seen central banks provide liquidity, governments announce guarantees, and regulators change rules to stabilize conditions. These moves are almost never clean or perfect. They're made by human beings under intense pressure. The immediate reaction I see is often confusion, not relief. Some investors take intervention as proof that the worst is over. Others see it as confirmation that things are worse than they were told. Markets swing wildly in both directions as everyone tries to interpret each new announcement. After enough selling, something quieter starts to happen that I've learned to watch for. Selling pressure eases, not because optimism has returned, but because the forced sellers have mostly finished. Margin calls ease, liquidations slow, and the weakest players have failed, merged, or been absorbed. The internal mechanics of the market begin to stabilize. Prices can still be depressed and headlines gloomy, but the foundation is no longer deteriorating at the same speed. That's usually where I start to see real long-term opportunities. Valuations become reasonable, panic has burned itself out, and strong businesses are available at attractive prices. Most investors I know are too exhausted or traumatized to move. The people who act in that phase rarely feel brave. They simply appear calm and methodical, the way I try to be. Years later, everyone calls what they did brilliant. In the moment, they were just doing what made sense, while others focused entirely on emotional recovery. Then, as markets recover and time passes, I watch memory fade. New participants arrive, risk feels cheap again, and leverage creeps back into the system. Optimism grows, and the lessons of the last crisis lose their sting. Quietly, the groundwork for the next downturn is laid. Crises repeat in my lifetime, not because markets are somehow cursed, but because human behavior doesn't change. Fear, overconfidence, denial, and forgetfulness cycle over and over. Understanding that pattern has been far more useful to me than trying to predict any single event. The key point I want you to remember is that a crisis unfolds as a process, not a single moment. It moves through stages I've seen again and again, and knowing those stages reduces the shock each time. Maximum fear is rarely the point of maximum long-term risk. For disciplined investors, it's often when opportunity first appears. You don't need to time every stage the way a trader might. That's not the game I play. The real goal is to avoid panicking at peak fear and avoid overreaching at peak enthusiasm. In the next part of our conversation, I'll translate this whole framework into clear principles I rely on when emotions are loud and clarity is scarce, so you have something solid to hold on to when the noise gets loud. You know, people think investing is about numbers on a page, but over a lifetime, it's really about how you carry yourself through uncertainty, disappointment, and surprise. What a good financial life really is. Let me tell you something, my friend. If you get to the end of your life with enough money, people who love you, and the ability to sleep well at night, you've done just fine. I'm not chasing some invisible contest of who died with the biggest net worth. The goal is to have your money support your life, not become your life. I've seen a lot of very rich people fail at that. They spend decades glued to screens, tied in knots over every tick, never feeling safe, no matter how much they accumulate. That's not wealth. That's captivity. Real wealth is when you can say, I don't have to react to every noise. I know who I am, I know how I invest, and I know what really matters to me. Money is a tool, not a scorecard. Somewhere along the way, people turn money into a scorecard for self-worth. If the line goes up, they feel smart and important. If the line goes down, they feel stupid and small. That is a terrible deal, because markets will move your emotions like a yo-yo. You want to flip that relationship. Money is a tool to buy time with your family, to choose work you enjoy instead of work you're trapped in, to handle emergencies without panic, to be generous when you see a need. Once you see it that way, a crash looks different. It's not an attack on your identity. It's a fluctuation in one of the tools you use to live a decent life. You still take it seriously. You don't worship it. Accepting uncertainty as the price of admission. You understand there is no version of investing where you get both high returns and no uncertainty. If you demand absolute safety every year, you'll sit in cash and lose slowly to inflation. If you want the upside of owning productive businesses, you must accept that prices will fall sometimes, and sometimes sharply. The market is a device that transfers money from the impatient to the patient. When you accept that, downturns stop being proof that investing doesn't work and become the seasons you live through to enjoy the harvest later. You don't curse winter. You prepare for it. You dress for it. You remember spring is coming. Temperament over talent. People love talking about genius. Who made the clever trade? Who called the top or the bottom? Over a full lifetime, temperament beats talent. The investor who stays humble when things are good, stays calm when things are bad, admits mistakes quickly, and keeps learning slowly will beat the investor who is brilliant but arrogant, overconfident, and emotional. You don't need to be the next anything. You just need to be slightly more rational than the average person, consistently, for a long time. That is very achievable. Making peace with mistakes. Let me confess something to you. Even with all the experience, the reading, the partners, and the resources, mistakes never fully go away. You will still buy things that don't work out. You will still misjudge some people. You will still look back and say, I should have seen that. The key is not to eliminate mistakes. The key is to make survivable mistakes. Don't bet the house. Don't tie your whole future to one stock, one sector, one story. Don't use so much leverage that one bad break erases 20 years of effort. If your mistakes set you back a little but don't knock you out of the game, time and discipline can still carry you forward. And learn from them. Write down what happened, what you were thinking, what you do differently next time. That's how tuition turns into wisdom instead of just pain. What to hold on to if 2026 gets rough. If 2026 turns out to be a tough year, a crisis, a crash, or just a long, grinding downturn, here's what you hold on to. First, remember that the headlines are temporary, but your horizon doesn't have to be. The world will still need energy, food, shelter, communication, healthcare, and 1,000 other goods and services after any crisis. Second, remember that other people's panic does not have to become your panic. You can see it, feel it, acknowledge it, and still choose your own response. Third, remember that your real wealth is not just your portfolio. It's your skills, your relationships, your reputation, your habits. Those compound too. If you keep those strong in bad times, you're in a much better position to benefit when the clouds clear. An old man's simple advice: if we were really sitting at that kitchen table in Omaha and you asked, what should I really do with all of this? Here's what I'd tell you. Live below your means so you are never a forced seller. Own a simple, sensible portfolio you actually understand. Keep enough cash that you can face a downturn without fear. Treat every crisis as both a test of character and a chance to buy future prosperity at a discount. And don't let money become the thing that steals your peace. You're not trying to be a hero in 2026. You're trying to still be standing and reasonably happy in 2046 and beyond. If my mistakes and scars can save you a few of your own, then they were worth more than any stock that ever went up. Stay rational, stay patient, take care of the people around you, and let the markets do what they've always done over time. Reward those who behave well when it would be easiest to behave badly.